Yeah. All right, good morning. We'll be starting this session by reviewing what happened last week, looking forward to what's going to happen this week, and finding some volatility pockets, and also jotting one or two economies against each other to see where the best trades are. And starting off by having a quick look at the weekly candles here on the left panel. You can see we're looking at GBPUSD. GBPUSD did a bit of a spike up, spike down. Didn't really do a lot last week to give us a tactical advantage to either short it or to buy it. On the other side, we had AUD Jpy, which did just incredible moves. Most yen pairs did, but AUD Jpy in particular is just currently non-stop pushing. To be honest, the first 200-300 pips right around 88 level, push 90 level, I was on board. Beyond that, I think it's excessive. I'm not too sure how much further this can run. From a macro perspective, fair enough, we've got inflation and it might be peaking at some point, but I really feel like at this point it is a bit excessive, the move on AUD Jpy. Look at EURUSD, and the move was quite positive. Again, AUD is finding a lot of bids. This trade here, we've or the direction on this is more or less still the same. So we've recently just broken yearly lows or yearly open, and it's continuing to push lower. We're going to have a look at yield spread, see if there's more to it. GBPJPY more or less doing the same with the other yen pairs. The yen is aggressively getting sold, and Euro AUD, that was again part of the trades we wanted to get in last week. Let's see what else we got. The Euro JPY, incredible move. Euro GBP not doing a lot. So last week it came down about 50 pips. It's still playing in the range it started to create in the back of November last year. Excuse me. EURUSD, so we're quite bearish on it. We're hoping to see the 90 level last week. Unfortunately, the entire weekly range was hardly 70 pips. That's not a lot. So I still see pressure to the downside for euro, as inflation is not positive for the euro economy right now, as the ECB can't do a lot about it, and it's going to hit the economy harder in the coming month. Plus the Ukraine invasion is putting the trade-off between Russia and Germany. That's not positive either. All in all, expect EURUSD to come push lower, but we're going to incorporate this in this weekly analysis. Euro NZD more or less doing the same as Euro AUD does. NZD USD, now where's NZD USD going to go from here? It's a good question. There's one or two things we can look at to determine where the direction is for the NZD USD. It put a bottom in the last week of January, and since then it's been rallying about 450 odd pips. There's still room for this to go higher. That's not the end of it. So I'm gonna plot a yield spread chart first and see what there is to work with. The yield spread chart really never supported that dip to start off with. It was always going to say, look, we're going to be bullish. It was quite interesting that we saw this re-emergence here. But apart from that, let's go down to the daily, see if we can find a little bit more nuances. So here we had a decoupling where NZD USD just tanked. Then eventually yield spread came down as well, but yield spread started rallying again. And most recently, yield spreads came down. You expect NZD USD to come down with it eventually if yield spread stays lower, but we are not expecting that just now. We're expecting the RBNZ to be a bit more aggressive with their policy, and I expect NZD USD to still crawl up a little bit higher. And so let's see how that goes. All right, so let's continue having a look at these weekly candles. Just wanted to have a quick bash at NZD USD and see if this is the top. Doesn't look like it is. The NZD Jpy, again, magnificent rally from these lows, about 1,100, 1,000 pips. USD Zloty, USD Jpy. Yeah, very strong move. USD CHF trying to play the highs, which is inverse correlated with EURUSD. So as this crawls higher, expect EURUSD to drop lower. USD CAD, very interesting. So last week we were bearish. We shorted it, somehow ended up still losing money on it because I think we're running it too tight of a stop. And now we're at these levels where you think, okay, what's going to happen from here? We've cracked the 125 level. We trailed underneath it. And the question is now, are we going to see lower levels? Is this going to start bouncing about? So we're going to have a look into that as well. USD TRY, USD RAND, and Yuan. Yuan is depreciating, interesting. Last week we had an undecisive move on the DAX. We're still quite bearish on it because the way inflation is hitting the economy in Europe. S&P 500 did a solid, down not so much. Gold is really just now bouncing about in a really wide ranges without any particular direction. Oil had a good move, but this morning is having a setback. We're still expecting this to crawl higher. Let's have a quick look at VIX. VIX started attempting to come onto the 20 level, but it didn't quite right, and it's still trying to move under that. So once we see move under that, you see the dip buyers are more aggressively in the S&P 500. So that's something to keep an eye on. A quick look also on our yields. Excuse me. So 2-year spread between Germany and the US is firmly in the favor, obviously, of the US, as the US is raising rates. The 10-year is finally falling to the bottom of the range. We still expect this actually to punch lower and then drag EURUSD with it. And the US yields curve is 11 points away from inversion in the all-important recessionary signals. And right, the 30s, yeah. So the, what's it called? The 30 and the 5-year yield curve already inverted, which is not good, obviously, for the economy going into next year. We're very likely heading into a recession. There's really not a lot that's going to stop a recession from happening next year. And it's interesting to see how, excuse me, it's interesting to see how we're going to see some of these commodity currencies react, because they're usually very global, reflationary driven. So right now the recession hasn't hit yet. So we're going to wait for that to happen. But eventually AUD, NZD, CAD, they all will react aggressively lower. And that's not very good for those currencies, because eventually they will all crash very aggressively. So all these big moves you're seeing in AUD, let's take AUD, JPY, and all of that, they won't hold, obviously. They're going to come back down once that recession hits. And so, well, we need to wait for this to come through. You know, we need the data to see that, oh, look, we're losing ground here, because right now market is still pricing a reflationary environment. So we're gonna keep on the ball with that to see how it's all going on. Let's have a quick look also at some of the individual 10-year yields. So the German 10-year yield is punching at 0.6, UK 1.7, US 2.5, clip 2.5, and it's still quite aggressive. Japanese are at the edge of what we expect the Bank of Japan to, you know, to defend. So it would be very interesting to see how this all pans out. We're keeping an eye on that as well. And apart from that, I don't think there is a lot more to report. Everything seems to be more or less in line with. There's no real trend change yet, basically. That's what I'm trying to say. So we're going to keep an eye on these, and then now we can crack on this sort of a weekly analysis to see where the volatility is and what are the best trades to catch for the week ahead. Yeah, I don't think there's a lot more we need to look into. Let's crack on by having a look at our inflation gauges. All right, I'd like to have a look at that. Let's start off the session by where the 5-year inflation is sitting. So this has been last time updated on the 25th, which should have been, was 25th, was Sunday, wasn't it? Sorry, Friday. So 27, 20, so yeah, 25th was Friday. So last time was updated. We traded around here. If I come to compare this with AUD Jpy, you can see they're still running together. And honestly, don't expect a reversal in yen pairs until you see that market is stop this hedging activity. So don't step ahead of the short, ahead of the AUD Jpy rallying like that. It's quite aggressive. Obviously, these things happen once in a very, very long time. I myself expected it to top out around these levels and then come back down, but it hasn't happened, and I didn't step in front of it either. There's no point stepping in front of it until you see a good rejection, until you see the bond market come down, and that's when you can short those trades. But until then, there's absolutely no point. As we are headed for an inversion, obviously, it's good to mention that what the whole dynamic is. I'm going to bring quickly out my annotation tool here, just so you can draw up a whole big scenario. So the thing happens, for instance, if you have 0 here and your yield curve, you know, starts trading and hits under 0, right? This is not the problem, actually. Hitting 0 is not the problem. The problem when it comes out of 0. So it's the re-steepening that is causing the recession, funny enough. It's not going into 0, because it can go into 0, it can go back into 0, you know, and stay there for a long time. This is not what's going to cause the recession. What happens to the recession is when it comes back out like that. Because why? Because what the Federal Reserve starts doing is they start cutting rates, and they're going to collapse the front end, and the long end is going to stay where it is, and then that's going to re-steepen quite aggressively the yield curve. That's when you're going to see recession hitting you, and that's when you want to start worrying, shorting stocks and shorting all these cyclicals and all of that. While we're hitting 0 and while we stay under 0, that's not the problem. You want to be concerned about the re-steepening. That's nothing you find in any rule book or any. Nobody tells you that kind of stuff, right? Nobody will tell you re-steepening is actually recession and not going into, not hitting an inversion. I'm going to show you this on the chart in a moment. Let's close this. And I'm going to show you where the yield curve is on the US. Actually, while we're here looking at the US yield curve, I'm quite intrigued what the other ones are doing as well. So actually, before we crack on with that, let's have a quick look at what the UK one is doing. The UK one is still trading in positive territory. Right, interesting. But looking at the US one, right, and I'm going to draw out, I already have the 0 level here, and I just want to show you something on the bigger picture and bigger time frames. Let's go, let's say monthly, because over the last, I don't know, 2 decades, it just happened once or twice. It happened before as well. But I don't want to start analyzing the 80s and the 90s. This video will never end. If you go back to the not the last recession, but the one before, the GFC, that you can see it a bit better. So we had obviously the yield curve tanking on the back of policy, and then it went into 0. It came out, but it went and stood under the 0. And we had no recession in any of these periods. The recession actually did not come until 2007, 2008, when we had this aggressive re-steepening. And I'm going to show you this when I compare, for instance, the S&P 500 for you. I could actually do the AUD Jpy as well in a moment, which I will. Let's do the S&P 500 first, so you get to see what the reactions are really are, with the whole what's it called, with the whole recession. So obviously once recession hits, the S&P 500 will take a hit with it, as you found out in 2020. But S&P 500 really started collapsing in October 2007, right? So that's what the first time it inverted was about nearly 2 years before that, we started inverting. But we started kicking about in those levels, and that was not recessionary yet. What happened is this aggressive spike up. So we had 2 or 3 months, like S&P 500 actually started topping out once we had this aggressive starting in the re-steepening in the yield curve. And we had the June, then we had July, August, and then we had a double top by the time October hit, and S&P 500 did not look back. It just lost 30. No, how much did it lose in value? It was quite a lot. Because I'm on this chart, I can't see that yet, but it lost quite a lot of value. I think it was about 30 or 40%. Until then, it started picking up again. And the same thing happened in the last recession. So we didn't hit recession once we hit zero, or we were near zero. We only hit recession once we saw the re-steepening. So we hit the yield curve inverted in August 2019, and then re-steepened, right? And the S&P 500 didn't care until maybe January 2020. That's when the re-steepening got a bit more aggressive. Obviously, we had the pandemic hit and all of that. And then what the Fed did, they started aggressively supporting the economy. That's why the dip in the S&P 500 wasn't that aggressive like the last recession. But again, it's not, don't need to be worried about when it goes zero. You need to be worried about the re-steepening. And then eventually everything hits and collapses. So now this time around, it's not going to be any different. So this is the S&P 500, obviously struggling most recently, climbing out. But the problem is not going to be this going to zero. The problem is going to be when this starts popping back out. That's when you want to start getting aggressively short some of the cyclicals, and that's when the recession actually happens. And if I were to compare this with AUD JPY, you can see here that the re-steepening is really where the money is in this whole recessionary scenario. That's what I'm trying to say. So here you get the re-steepening. I'm very certain we saw the same thing in 2000 as well. So the dot-com bubble, and then we saw the re-steepening, and that was really quite bad for the bigger terms. Right now, the reason why we have this aggressive decoupling is because commodity prices are going mental, and Japanese investors need to protect against inflation. So until this continues, we're going to see these moves continue. I can't tell you where it's going to stop, but this is something you want to keep an eye on. This is the reason really behind why it's all going up so aggressively. So we covered this whole yield curve scenario. I think it's important as we are headed towards an inversion, and many people will start screaming recession. Really, what you want to be worried about, since you're educated, you want to be worried about once it starts re-steepening really aggressively. A good 1 or 2 months of re-steepening, and you can be fairly certain that the economy will collapse thereafter. And let's have 1 or 2 look at some articles, right? Let's do a little bit more. Let's do a little proper research here. So what's on this week's, what's on everyone's mind this week is obviously petrol and diesel prices. So will OPEC increase oil output as Russia disruption lifts prices? And that's one of the question market has, and obviously repercussions for oil. In the oil market, this week, all eyes will be on OPEC next ministerial meeting on Thursday, after G7 leaders call on the producer group led by Saudi Arabia to boost output to compensate for the disruption generated by Russia's invasion of Ukraine. The US has been pressuring Saudi Arabia and other OPEC members to increase output since September, but G7 statement up the ante. And members of the OPEC Plus alliance, which includes Russia, have so far stuck to the plan agreed last year to only gradually replace production cuts. But with analysts forecasting that a growing international boycott will force Russian production to fall by as much as 3 billion barrels from April, OPEC case for business as usual is weakening. If OPEC members accept that Russian production is likely to fall significantly, there are few advantages and multiple disadvantages staying within the current OPEC Plus agreement. Let's quickly skip over this. 1,000 barrels of base spare capacity is now estimated to have fallen to between 2 million and 3 million, concentrated in Saudi Arabia and UAE. top oil traders, financial times, commodities, commodity funding argued even though those low spare capacity figures were overstated, and Saudi Arabia was sticking to the OPEC Plus agreement because it does not have any more barrels to offer. King predicted Brent crude, which was trading at 160 barrel on Friday, which soared to between 200 and 250 barrel this year. That is a huge increase. And by the way, and it's very interesting to say this, market is not reflecting the fundamentals of oil right now. So let me show you oil. And they're talking about Brent because Brent is always trading at a premium, but I'm going to show you the West Texas Intermediate. They're all going to be trading up anyway, so there's no huge point to differentiate. So here we've got that's Brent, but let's have a look at WTI because there's the one I mostly follow. If I can find it, that is. For some reason I can't find it now. So that's CL, isn't it? Yeah, US. It's a CFD. It's on the US oil. Excuse me. So on the daily, you can see we had the spike up after the invasion started, and market started pricing some of the disruptions. However, the way that the fundamentals are playing out, it's not reflected in the price. The fundamentals are a little bit worse, and it looks like unless there's a demand destruction, people stop flying, or there's going to be lockdowns, or demand for oil starts falling off. With the current demand structure, oil should be trading higher than that. It should be trading in these levels because of the supply disruptions. So there's disruptions to Russian oil and Saudi Arabia and UAE. They're pretty much at capacity, and all of that is contributing for elevated oil prices. And it doesn't look like this top is holding. We're going to see higher prices and eventually a huge collapse of the economies and all of that. So when you see like traders saying it can trade between 200 and 250 a barrel, they're not really wrong. When you look at the fundamentals, they're not that wrong. The fundamentals are aggressively in favor of higher prices. So will the US economy record a third month of powerful jobs growth? On Friday, we're going to have the NFP, and the closely watched Labor Department report on Friday is forecast to show that 488 jobs were added in March compared to 678,000 in February, and unemployment fell again to 3.7 from 3.8. US jobs report has dramatically exceeded expectations in recent months. February was expected to show 400,000 jobs were added, surprise jobs, blah, blah, blah. The report will be the first since the Federal Reserve raised rates. Expected rates at each and subsequent meeting this year, while a stronger report could point to continued inflationary pressures in the labor market. A weak report could raise questions about the capacity of the US economy to withstand the slowdown that typically accompanies rate increases, while a stronger report could point to continued inflationary pressures in the labor market. Right, good. We now know that. Will Eurozone inflation reach a new record high? So we're going to have Eurozone inflation today. So see, we already have 2 or 3 points. I'm going to take notes here as we move along. So on Thursday, we have the OPEC meeting, which is quite important to us. On Friday, we will have NFP, which we will keep an eye on. If it's high numbers, right, it tells you that inflation is picking up. And since you are following really closely, you know that higher inflation is really bad for Euro right now. That means a good NFP print is what for EURUSD? Is negative. So you're going to expect some negative reaction if you have good NFPs to EURUSD. And OPEC is difficult to determine what the OPEC outcome is, but we know we're going to have some really crazy volatility in the oil market surrounding Thursday. Now, we've got Eurozone inflation as well. And it's expected to have surged from all-time high of 5.9%, which in the previous month. Economist Paul Reuters forecast consumer prices to have growth accelerated 6.5%, and when the flash estimates is released on Friday. So on Friday, we also have, I'm going to jot this down, Euro inflation, right? Which right now is not that positive anymore, as ECB isn't as aggressive as you need them to be. So core inflation, which excludes the more volatile food energy price, expected to jump 3.3% from 2.9% in the previous month. This means that headline inflation would be running at more than 3 times the 2% target of the European Central Bank, with surging energy prices following Russia's invasion of Ukraine pointing to a further acceleration in the month ahead. High inflation is largely expected to materialize through more expensive energy costs, but other factors are also forecast to play a role. Following a war, Ukraine major supplies. Based on past evidence, we estimated this will considerably increase food inflation in the Eurozone around 6 months from now. Huge statement. So following the war, price of agricultural commodities and fertilizers, of which both Russia and Ukraine are major suppliers, have also increased substantially. I've seen some of these fertilizers trading 400% higher. So based on past evidence, we estimate this will considerably increase food inflation in the Eurozone around 6 months from now. So we're end of March, so about September, October, inflation is going to hit again the Eurozone, and there's not a lot that the ECB can do about it. As a result, Hollingsworth now expect headline inflation to peak 7.4% on average in the second quarter, pushing the annual rate to 6.7%. Later is up from forecast 5% from the war. So they're not expecting inflation to peak until the second quarter. Economists are closely monitoring signs of wage inflation spiral, where rising workers' compensation feeds into more persistent domestic price pressures. Hollingsworth said that little evidence so far of stronger wage growth, but he did add it is only a matter of time. So it's all, it's all just chain reaction, really. This is what we're seeing most recently. We can close that. We have an idea roughly. I've brought out this what's it called? This article about fertilizer inflation and global prices going up, and it's a good article, I think, to read later on. I'm going to keep this open. If there's time in the end of in the end of our video, I will go through it. It's just really putting into picture what the higher fertilizer prices mean for food production, also prices. I won't go into much more detail now. I said I'm going to jot a couple of economies against each other to see if there's any strength in one economy than the other. So what you can see here is the City Economic Surprise Index. That doesn't mean one economy is doing better than the other. That means that data in one economy is printing higher than estimates. For instance, in Japan, the data recently has been printing lower than estimates. In Switzerland, they've been printing better than expectations, so on and so forth. So a quick glimpse at all of this, and New Zealand isn't really looking that good. The Eurozone is picking up a little bit. Canada doing extremely good, having a spike up. Australia is doing not that well. UK is doing good, and the US is also doing not too bad. It gives you a rough idea that where the economic surprise indexes lie. It doesn't always give you direction on what trade to take, but it gives you an idea. For instance, if you have, like now, we have obviously economies are doing well, and we've got Canadian dollar showing economic surprise index higher. For instance, we have New Zealand showing not that well, and the Eurozone slowing. Maybe we can jot these two trades again. So for instance, if I look at EURUCAD, I'm expecting this to come down. Or if I'm looking at NZD-CAD as well, we should be seeing some more downdrafts. So let's see if that is true. NZD-CAD, and we're looking at the daily, and it looks like it's stalling. Yeah, so more or less the economic surprise index is giving us an indication there. And EURUCAD, very starkly, you can see that a bit easier. Again, this is on the back of obviously Euro using a lot of value because of inflation and so on and so forth. I've done, and I'm just interjecting this, but I've done research in the past to see if there is a correlation between EURUCAD and EURUSD at specific points. So not like, you see overall correlations where different softwares calculate it. But overall, I've did a bit of analysis, and it was actually very interesting to see that EURUSD at inflection points actually correlate very strongly. Now, overlaying this chart, you would think, oh, this is picture perfect, right? So EURUSD and EURUCAD seem to be moving picture perfect. But in trading real life, it's not always the case. Here we had some cutting it about. It's an inflection point I was more interested in, when something happens or breaks. An inflection point, Euro USD and Euro CAD seem to be trading hand in hand. It's very encouraging to see Euro CAD already pushing yearly lows and Euro USD hanging behind. I expected more or less the same happen really for Euro USD as well. And we're going to see lower levels. So last week I was expecting 190 to give way. Honestly, the way the inflation is panning out, there's no reason to not expect lower levels, and eventually 1.6 and 1.5 for Euro USD, and as the months roll on. So that's a sort of a trade in the direction we want to take. But this is about inflation economic surprise index. We also have Australia losing against the UK. You could say, oh, so maybe GBPUSD could go up. That's not true, because obviously AUD is right now trading based on commodity prices going higher. So economic hasn't got a lot of play room in here just now. But keep that in mind when you see stuff like that. And there's one or two economies that are trading neutral. You could use this chart and then plot one against the other to come up with trade ideas. And this is a quick overview of what currency's been doing good so far this year versus USD, and most of them are not doing that well. So we've got AUD, NZD, and CAD, the commodity currencies, mostly doing well, and everything else is losing value against the USD. And see if there's anything else I can find that is useful to our purposes in this report. Commodity prices. Yeah, so the CRB index is just through the roof, right? City terms of trade. City terms of trade is sometimes useful to have an eye on. Interesting to see that Australia is losing. I thought it would be going higher, but terms of trade is, I'm not going to go into it, it's too long to explain, but basically is when the economy is really attractive to but the currency is really attractive to trade with, basically. And right now, Australian dollar isn't that attractive because the prices went higher, but also the commodities are sitting higher. So it's a lot that goes into this report, and I don't want to cover this and this, especially as it doesn't really reveal a lot about finding trades, but it's more so direction guide. So we've got GDP growth rate, very, very important thing, obviously, for the economies. And we're having a look at US is doing actually not bad. It's trading in higher percentiles. Australia is doing extremely good. However, I need to see when this last time was updated for Australia. Japan doing well. New Zealand is doing really badly. Eurozone doing badly, in UK as well. So they're both not really sending a lot of lead to the pencil, and some of the other economies are doing so. So Canada is doing a bit better. IHS market PMIs, very important indicator. So here you get to see, obviously, some of the key ISM services and manufacturing across different economies. So here you can see, I think this is Canada, and here you get to see EU ISM manufacturing for the UK. And there's also the global composite PMIs and EU as well. So they're all still trading very elevated. None of them collapsed on the 50s. There's nothing to worry about just yet. And headline CPIs, Australia is trading about 3.54. US is hitting into the 8 level. New Zealand quite elevated. Japan, for the first time in a very long time, trading higher as well. UK edging around 6, and the Eurozone this week we'll find out where this is going to end. The expectation is to trade above 7 as well. And some of the other economies having a quick look at as well. The implied interest rates, not something we need to worry about just now because we have a good idea where these are trading. I want to have one last look at volatility structure. This will give us an indication of what market, of what currency pair is going to be most volatile in a few weeks or months ahead. So look at the left-hand side of all of this, and the higher the number, the more volatility you have. And on the right-hand side, you can see 1 week, 2 weeks, a month, and years ahead. So the longer this stays elevated, obviously, the longer you're going to have volatility in certain pairs, and the more it drops, the less it's going to be. So we're going to quickly do a rundown so you get a feel and understanding for it. EURUSD right now, volatility extremely high, and about 13 or 14. Usually it's trading way under 10 or 11. And this is expected to continue for another month based on options, right? So that you can expect EURUSD to continue to trade a bit more volatile until the end of April. USD Jpy, this is really nothing to worry about, and looks like volatility is dropping off. GBPUSD volatility is dropping off quite aggressively. And what we've got here, USD Yuan, AUD quite high volatility as well, and it's not peaking yet, it's expecting to pick up. And it's still trading between 13 and 14 again for another month before really starts getting dropping down in about May. What we have got here, USD CAD is going to pick up towards the beginning of summer, so around June or so. Very interesting to start thinking USD CAD trades later on when these are dropping off. And Euro GBP is continuously dying off the volatility. NZD USD is now repricing lower as well. Good to know. I'm not really interested to see what I saw in EURUSD. There's obviously on the back of the Ukraine war, market is still very elevated with the options volatility pricing. Right, good to know. We're going to stick with that, and we can now move on to have some to have a look at some other analysis. So we're going to have a look at one or two of our bank researchers that I always like to have a look at to really fine tooth to see what we can expect for the week ahead, and so on and so forth. And so we had to look at that, and maybe we're going to have a look at Bloomberg as well. So we can really bring home the whole act. So far, again, we have Thursday and Friday as some key volatility movers, and we're quite keen to short EURUSD as well, as you know by now. So I'm looking here at EURUSD. Volatility is going to still be a bit elevated, but we're expecting this to. This box here is Monday's fix from last week, and it was holding the entire week off. Very interesting. Since we have you here, let's have a look at what the other fix could be. That's quite important. So Thursday fixes are important for the following week usually. Now we like EURUSD to trade under this box for the remainder of the week, and we can get some shorts in here and get a bit more aggressive. But let's have a look at our sort of research to see what the week ahead holds. Market pricing of risk bank, market pricing, crude common low on China, COVID lockdowns, but supply deficits are looming. So read something about oil and other large foreign goods consumptions, Nordic alert, morning alert, the week ahead. Euro area, well, let's have a look at that because we're interested in that. And let's have a look at week ahead. So a couple of articles quickly are dragged out, and I'm going to quickly skim through to just really extract the important parts. Global outlook: the war in Ukraine is entering a new and highly uncertain phase as Russian troops stop their advance and dig into defend occupied territory. Information is incomplete. Escalation of rising economic chaos. Our main scenario fight in the next couple of months looks like to be less intense. Satellite imagery and satellite intelligence gives indication of what Putin is planning, but if the scenario's whole market will be less focused on the war, at least temporarily implying the risk appetite may recover somewhat. This data releases, especially covering activity in March, will be important to watch for clues on how market will move in the near term. The US 2030 budget proposal set to publish on Monday will be shown by inflation spending priorities. Much attention will be related to what should be provided for Ukraine. There will OPEC plus increase output by 400,000 in April, rejecting calls for faster increase to curb rising prices. As long as prices are low enough to avoid demand destruction, keep US producers from increasing supply sharply. OPEC plus producers are on balance happy with higher prices. With inflation under control, except in Russia, higher prices provide a welcome boost to government coffers. Markets will face a heavy date. Friday, non-farm payrolls, PMIs for all major economies in Eurozone, CPI. Warning from ECB inflation may reach 7.1 in the coming month. Way to lose 1 hour of sleep on Sunday. Good to mention, by the way, most here in Europe, So in the UK and Europe, we moved forward 1 hour. So if you see anywhere writing, for instance, 8 a.m. GMT, that is 1 hour back. So right now we are trading under BST because it's British summertime. Nordic outlook, not so important. Good. So basically here, really just covered what we already know. OPEC meeting is really important. And on Friday, we're going to have a lot of data dump coming in. And SAP research lower on China. So this is the global outlook we have. Brent crude is sliding 4% on China lockdowns. So this is why we saw US oil or Brent coming down. It is on the back of lockdowns in China. So the initial push here we had was because of Saudi Arabia and some oil fields, where the initial drop here was really because we're trading over 25 and a lot of hedges came off and all of that. Then we went up because of some oil fields were hitting in Saudi Arabia. They were hit by drone strikes. And now we're coming off a little bit because of the lockdowns in China. We're following the story here. Demand will likely weaken by 0.5 million barrels in April, with more than 200 million people affected. Concerns for loss of Russian supplies put aside for the moment. Expectation are that 2.5 million barrels of Russian crude and products will be lost in April. Russian oil is oil is still flowing close to normal as one of those volumes were contracted before the invasion. Spot volumes are likely to be strong, effective. Diesel markets are already ultra tight as Russian refineries reduce runs or shuts. We are looking into diesel squeeze where light sweet crudes normally get strongly bid. So obviously, if you have a diesel car, you're gonna be in a lot of pain as prices will soar. Soft Chinese demand weakness this morning. The Brent May contract Friday on a week close, and this morning the contract is selling down 3.4%. Weakening oil demand in China due to lockdowns is driving it lower this morning. Chinese oil demand is expected. Ongoing lockdowns will affect more than 200 million people. Global market to lose 2.5 million of Russian oil. The rest of them is major oil trading from the Trafigura, Vitol, and Mercuria seem to more or less unanimously agreeing that between 2 and 3 million barrels of crude products from Russia export will be lost to the global market. The consensus is a loss of 2.5 million, of which 1.5 billion crude and 1 million oil products. There is a net loss to the global market, including loss of demand for oil products in Russia of 0.5 million barrels. Flows of crude and products out of Russia have been flowing close to normal in March. And added purchase from India, China will not be enough to compensate for lost buying interest from the rest of the world. Russia crudes like Urals trade at deep discount. Oil market story right now is a bit tricky. Current availability of crude oil is quite okay. Russian oil is flowing to market close to normal. Low price discounts for Russian spot volumes are huge. Going to April, however, we're going to experience real supply issues, as most of Russian spot volumes are likely going to struggle to find buyers. So the real problem is for oil going into April, not now. And that's when we're likely gonna see these oil prices absolutely wrecking the chart higher. So don't look at this now. It's sitting in this tight range. All the data we are looking at and the macro points we're looking at, and it's worth looking and fine-tooth combing through the EIE data and all of that as well, so you can really see the data coming through. But everything from the macro point pointing that in April, or very closely, even maybe before that, we're going to push higher, irrespective of what OPEC is going to do on Thursday. European and global diesel crunch. European the supplies of oil market, especially in the south, lack of byproducts. Okay, hot activity, lack of buyers. Okay, European 10 diesel prices traded to high week before setting ton highs since 2008. Russian refineries are very important for Europe. Normally supplies about 750,000 barrels of diesel products. During the latest couple of years, there has been a significant closure of refineries globally due to exceptionally weak product demand and terrible refinery margins. The reviving demand from the global market is suddenly in a tight spot for middle distillates. This is further exacerbated by situation in Russia, where refineries now are reducing runs or shutting down to a lack of product demand. from Europe along with self-imposed fire strikes. Light sweet crude should also see strong diesel squeeze. Brent crude and light sweet prices normally get very strong a bit. Sweet corn prices for these. This diesel squeeze usually leads to a craving for light sweet crudes and price rallies for these. OPEC to lift. So it's important to also mention that obviously transportation is going to be heavily affected by higher diesel prices. So it really depends how high these diesel prices go, but they're not coming down anytime soon. So all your lorries, all your big trucks, they're all running on diesel. None of them are running on petrol, or none of them are running on electricity. That means that transportation price is going to go higher as well. And if there's going to be an issue with actually diesel and some petrol stations run out, then there will be a huge problem because transportation actually can't move forward. That's going to hit, that's going to create inflation again. Because why? I'm going to bring out my annotation tool here. If the diesel shortage continues, for instance, this is for instance, if this is a shelf in a supermarket, right? And they have like goods and all of that, and they're waiting for transportation to keep filling up because they're selling it to customers. What happens is if they can't transport and customers keep buying and it gets to the bottom of the shelf, the prices for these will all increase again, just to hold off the increasing demand. So you're going to see more inflation on the back of that if this comes through. But it's something I want to keep an eye on when I see diesel prices really moving higher in the petrol stations. And the bigger problem is going to be if there's no diesel availability and you see that transportation comes to a halt. OPEC Plus lift production by 430,000 as planned. OPEC Plus to meet this week to discuss May production. Won't be much discussion. They will decide to lift the cap in May as planned, though actual production won't rise accordingly. The price of RR10 ppm diesel is trading at a premium. Diesel market is super tight. So normal cracks, current versus normal. Right, so yeah, they're all trading at the premium, and this is going on. The premiums are trading well into the second quarter by the looks of it. If you see the current situation to what the normal is, this purple one, yeah, they're all trading in the premium all the way through October, 3.8 premium. So right now we're 20.8, 28.1, but it's supposed to get better as the year moves on. But it's certainly still really bad. So the premium is there. You want the premium to be away, like it is over here. Will be very close to zero. So the thing we're going to have the issue until summer with the diesel prices by the looks of it. Super backwardation, RR10, yeah, backwardation basically. Diesel market just won't go away, or not in the time being anyway, and it's just getting worse. US jet and mid distillate stocks well below the 2015-2019 range and keeps falling fast. So the stocks, basically the stocks of fuel are falling as well, which eventually will put up more upside pressure on oil distillates as well. So it's really the whole market for, it looks like the whole market for diesel and oil is looking extremely bad. There's a real squeeze here coming. It's not good for consumers, not at all. Good, now we know that. How long we are into this video, by the way? I don't want to drag it out too much. We're now running over nearly 1 hour. So we're going to wrap this up in the next 10-15 minutes. If you have any questions, by the way, type them up in the chat box and I will cover it as soon as I can. Euro area, so some resilience, but prices turning high. European flash PMI sending clear message: prices will continue higher from already high levels. Past month improvements of supply side disruption are now turning worse. Expectation for production ahead turn markedly lower. However, we still see some solid strength in the underlying recovery from the pandemic. The question remains if the service sector recovery from the pandemic can counteract a larger decline in manufacturing. The March flash PMI is the first indication of economic impact from the war in Ukraine. The timing is fairly similar compared with the pandemic 2 years ago when PMIs plummeted in March. In our view, the prospects of an equally weak PMI is low, but the direction should be markedly lower reading starting from now. Our key takeaways from French, German, Euro IPO: prices continue higher, delivery time, supply side disruption getting worse, surprisingly resilient. It's easy to forget the European we are generally cautious due to the war, most likely will delay parts of the recovery, weaker expectations than past performance. It's not rocket science in an environment in which the prerequisite turn dramatically in a different direction. Assessment on past performance to some extent outweigh a gloomier picture for the future. So it looks like we are expecting PMIs to come lower, really. The prices are going higher, deliveries are getting worse, and the whole recovery is so far holding by expectations of lower levels. Okay, not a lot to take away from here. And let's have a look at a weekly focus from Danske as well, see if there's anything else we need to focus on that we don't know about yet. Let's have a quick look at some of these FX strategies as well. And I also forgot to have a look at the Scotiabank report on CFTC. Let's have a look at that too. It's always good to have in the picture, see if it's updated or not. So it's been updated on Fridays, looks good. Quick look at our positioning gauges here. And Euro longs are still adding. What is going on? Shorts are holding steady, but Euro longs are adding in an environment where Euro is not doing that well. Okay, but pound shorts are adding, right? That's driving it aggressively lower. And here, AUD shorts are adding as well, but that's never a takeaway for us. What are yen doing? Yen shorts adding, we're quite adding a lot, isn't it? Longs added a little bit as well. It's now about 8 billion short. Will be an epic unwind when it comes. And oil market longs reduced a bit, shorts reduced a bit as well. MXN is not in our current view. And apart from that, there's not a lot. See if there's any takeaway here from that. This week's central Brazilian sentiment among speculative investors revealed further improvement in broader bullish sentiment, but in a rebound that emerged from last week's data. Aggregate USD long rose by 4.6 billion in the week to 13 billion, the highest since early January. Biggest week over week change in position was reflecting the CAD position, with respect to the slash to net CAD long that the market had been nursing over the past few weeks of 1.8 billion. US CAD was in the midst of one of its best rallies in a number of years. Gross CAD longs were caught sharply again in the past week, while gross shorts edged fractionally higher. So there was some big movement in CAD. Was there? Yeah, so longs took some money off. Maybe that's why finally the Canadian dollar rallied a bit, because they were really just squeezing these people out. So not a lot to take away from the CFTC data, but what I'd like to have a look at is actually, I like to have a look at what the yield spread is doing between Canada and the US. So that is not telling us a big directional call. We're still caught in this, in the middle of all of this. The USD CAD is trying to maybe bounce off the bottom. What's interesting was a lot of Canadian longs covered in this dip. Interesting to see, really. So let's see how this all pans out. But positioning is getting lighter in USD CAD. This is really what the takeaway is. A bit of news on USD Jpy. We argue USD Jpy will be in the hands of the global energy crunch, since Japan's energy trade deficit will grow to an 8-year high, while US may become a small energy net exporter. That in turn will lead to an improvement of US relative terms of trade and support a high USD Jpy. This effect seems to have dominated the opposite PPP effect, purchasing power parity, by the way, from higher US inflation. We now forecast USD Jpy 125 in 1 month, 123 in 3 months, 121 in 6 months, and come down lower. See the pair test a high of 2015, and could potentially see the pair test a high of 2015. Now, when they wrote that was the 22nd, now we're looking at USD Jpy. USD Jpy already hit all those milestones, right? It's already trading. It's already trading at levels where it wasn't since 2015. The 2015 highs Yeah, so it's trading at a level where it wasn't since August 2015, and it's about 160 pips away from doing higher than that. And then it goes back into the territory where it wasn't in 2002. So this is the situation we find ourselves in. Excuse me. So it's really not telling us a lot more. The really market is expecting 125. Maybe not a lot more after that. Weekly focus, Fed is stepping up the pace. As the conflict in Ukraine remains frozen for now, markets have started shifting their attention to other topics. Excuse me, dry throat. And despite volatile oil prices rising, bond yields rose. US Treasury is now trading around 2.4. EU leaders agreed on more joint gas buying forward, although the embargo on Russian energy imports remains off the table for now. And announced expansion sanctions against more than 400 Russians. And current Fed now mounted seems to be get to neutral as fast as possible. And a range of SEC members this week talked about front-loading rate hikes, with none ruling out a 15 basis point at this point. So really what the Fed wants to do, they want to bring up the rates as fast as they can because they see the incoming recession. So market is now behind the curve. We see an increase in probability the Fed will tighten more and faster than we have penciled in. With some skewed towards Fed hiking by 15 basis points both in May and June, or 75 in one go. Tighter monetary policy and financial commodity price shock increase the risk of global recession 1-2 years down the road, which is also reflecting ongoing flattening of the US yield curve. We take closer economic implication from the war in Ukraine on Russia. The fortress Russia policies have already significantly weighed on the household. PMI figures March suggest that the hit to the euro area economy from the Ukraine war might have been less than feared. Coming immediate recession fears. That said, growth momentum in both manufacturing and services slowed, and future upper expectations have become more clouded. While the Ukraine war development will remain in focus amid signs of stalling Russian advance, next week central banks will also get more data to assess the state of labor market. So yeah, they're talking about keeping pressure ECB to normalize policy. As high input costs are still working their way up through the pricing, we see more downside risk for Chinese PMIs released on Thursday following recent headwinds from COVID-19 outbreaks, poverty sector stress, and rising commodity prices. So we just talking about Friday data and the Thursday for China. Let's maybe write this down as well. China PMI. So FX strategy sterling stability versus euro, but towards 125 versus USD. So Euro Jpy has moved lower since the year, mainly because a number of one-offs, not at least the Brexit. We expect Euro Jpy to stabilize around 0.84. The further rise in commodity prices can drive GBPUSD to 125 in 12 months. But terms of trade remain stable. So basically, we're seeing the inflation and commodity prices moving high to be a negative for GBPUSD. Where are you? And I say GBPUSD. I said GBPUSD should easily take out the 130 level. We discussed in the last video what the option barrier here was, and they pushed it higher. There in a research note say we expect this to drop to 125. Interestingly, we are also expecting EURUSD to drop towards 116 eventually. This is all coming together, isn't it? So if you look at these two charts, there's really very little doubt where the direction here is. And they're both looking very bearish, and that's the direction we should be trading as well. Since I have this chart up, it's worth having a look at the yield spread between those two economies. And looks like the yield spread is very negative for GBPUSD, and we're not really far away from seeing GBPUSD trading at lower levels. So at some point, I think GBPUSD was decoupled from the yield spread. It didn't really do the drop, but now it's kind of reflecting the drop, and we still expect this to come down. So very little doubts in terms of that. And a key driver here is inflation. So as long as you see higher elevated inflation prices, as long as you see oil prices sitting higher, expect that these trades should pan out as the month roll on and move on. So that's the direction we want to trade. And the Federal Reserve is out hiking. Bank of England, the cable usually moves lower when global manufacturing slows as well. Cool. Pound euro week ahead, forecast support near 119 but struggling above 120. Euro dollar week ahead, forecast struggling as bearish sentiments abound. Pound dollar week ahead, forecast resistance stymies rebound near 133. Japanese sellers looking to book profit near quarter line. New Zealand breaking higher on chance for correction, risk is high. Pound sterling forecast upgraded. So have a quick look at what these are. UBS easing lower through 2020. So Bank of America, Bank of America Global Research says they're expecting this to come out lower. Safe haven type attributes seen in GBP. Right, against EURUSD, I think they're talking. They're still saying that against GBPUSD, they're expecting lower end levels. The pound to dollar rate is, on the other hand, expected to continue the lengthy decline that has been ongoing since June 21, reached 129 by the end of June and 124 by year end. Rest of our forecasts are fairly binary, but we should suggest that resolution to conflict will have a large positive impact on the risk and specifically on euro. So if all of a sudden you see news headlines cross to say, look, Russia and Ukraine are having peace, obviously your short trade is going to get annihilated. But in any other case, expect these to come lower. And the forecast by banks for these are EURUSD to stabilize. But apart from that, I think we are looking, sterling, they're looking to see 120.84 the coming month for, and that's for euro, for GBPUSD, I think. GB euro. Okay. So over 80% of the UK's natural gas imports come from Norway, with only 15% from Russia. So it's a limited exposure. While the UK will still be affected by energy price shock, it does not face the same magnitude as Europe peers, and thus should outperform Euro, SEK, and Danish krona. And this means Euro will likely be sensitive to the outcome of negotiations between Russia, and which resume in Turkey on Monday and run through Wednesday, but would act as a headwind for the pound to euro rate if there results in any progress towards a ceasefire agreement resolution of the conflict. Meanwhile, Monday and Wednesday speeches from BOE Governor Bailey and Deputy Governor Broadbent will be listened to. So we have right on the negotiations, peace talk from Monday till Wednesday, which makes it difficult to trade euro intraday. So if there's anything positive coming out of that, you can be certain that euro will be trading very positively. So shorting euro will be difficult in the time being, but barring any resolution on the war, you can expect this to come down. Euro dollar week ahead, forecast struggling as bearish sentiment abound. I don't think they're telling us anything new here. MUFG, so Derry Halpenny says, while there's continued talk of progress and peace talks between Russia and Ukraine, this has been no clear breakthrough, and cautions that tips USD for fall towards 1.7 in the weeks ahead. Sorry. Fed has fueling a sharp flattening of the 210 curve, which tends to be supportive for the dollar. Cool. So we certainly have a trade here. We have a risk that the Russian talks with Ukraine amount to something, and that makes trading this on the short side dangerous. But apart from that, I don't think there's anything new there. Pound dollar week ahead forecast resistance time is rebound near 133, so 1.33. And here's talking about part. Right, nothing new to report here. So JPY sellers target 125, move to 125, Fed BOJ divergence, energy prices cited. The yen rebounded strongly. The Kuroda line near 125, there's a risk of further losses for Japanese currency over the coming days and weeks. The 10-year JGB traders highest 0.24 overnight, the highest for the cycle, and would theoretically require BOJ to come out and declare explicit renewed defense of the yield cap as it did back in February. Powell made it seem like the Fed stop plot may be too low and strongly indicated that a series of 50 basis points on the table. This should keep rate differentials firmly tilted towards JPY. Profit taking could be seen close to around here, so the 125.80 to 126. This should be help enforce the floor on the USD Jpy. The break of 100 is suggested in the 120, 125 range is upon us for now. This is all speculation. There's no thing, oh, definitely there's people coming to take profit. It's all speculations around the 125 level. And then GBPUSD 120, 163.80. There's going to be profit taking. There's nothing to suggest that's exactly how it will pan out. So having a quick look at USD JPY, we're right now coming off the 125.15 level. All right. So I had a look at Scotiabank report. It's worth looking at also what's moving CAD weekly. So CAD is right now still strongly correlated with S&P. And they're still expecting that minor USD CAD rallies are a sell on the back of commodities. So the 2-year spread is easing. So there's no premium for USD that developed in March. There are only a couple of data releases for Canadian next data. Again, has had a very positive run over the past couple of weeks. In fact, it's almost too positive. This is closed lower for 8 consecutive sessions. So losses may be coming due. Meet solid pressure. Right, they're still quite bearish then. They're expecting a forecast to 121, 120 for USD CAD. That's from the Scotiabank. And a quick look here, what market is doing. And also read about this. So here they're mentioning, obviously, recession warning. Part of the US yield curve has inverted. And here, so the yield curve, the 530s, which we just pointed out, inverted. And they're basically talking about that it could be a forebearer of recession. But really what this doesn't tell you is what I told you earlier is you shouldn't be worried about when it goes negative. You should be worried about when it aggressively re-steepens. That's when you get a recession. Where you could be sitting here negative and plotting around and nothing happens in the economy. It's actually positive. That's when it starts bursting higher. That's when you know that something is about to break. Traders said ECB hiked interest rates 4 times within a year. Wages are calm as inflation sinks with fresh record highs. Euro area bond extended losses led by short-term rates. So traders are expecting the ECB to hike. Figures on Friday are expected to confirm the consumer prices surge in March at the fastest pace on record. We think that the magnitude of these prints may as well cause disarray among ECB governing council. Eurofront rates are likely to be under pressure. Okay.
So look if there's anything on the. Yeah, this video was a bit longer because I wanted to go through all the little details we can go through there as possible to go through. And I hope you liked it. Oil declines after weekly gains as traders weigh war, inflation. So have a look at that. Okay, there's not a lot more to cover. I think we're wrapping up this video in 10 minutes or so. Just one or two articles are going through, and then we're going to have a look at the weekly calendar and see what we want to trade. Yen unraveling risk collapse to 120 as oil weighs. Sausage general strategies possibility of yen at 150 per dollar. Japan's currency hit by widening yield gap, rising commodities. Albert Edwards unraveling as traders get a bit between their teeth. When the yen breaks and moves sharply, despite being incredibly undervalued and oversold, the yen could yet plunge lower. FX volatility in recent years, and the spread between the two countries' benchmark yield has jumped almost 60 basis points this year to 2.13%. So they're thinking it could move up to 150. I think it can move to 150 as well, but it's not worth mentioning as I don't think this could happen this year. I think it's very aggressive thinking to see it happen this year. But if it happens, you know, if you see it move into those levels, then we at least have some sort of a reason to put behind it. I don't want to go through every single article right now. It's going to just make this video too long. Gold declines after weekly gains as traders weigh war, inflation. Bullion climb. The Westerners are soaring commodity prices. 10-year Treasury climb 2.5% on Monday. The Bank of Japan said it will purchase an unlimited amount of 10-year bonds at fixed rate. The second surge move in less than 2 months in a bid to keep rising. Yields in check. The yen weakened against the strong US dollar, hurting demand for bullion. As is priced in the greenback. Gold is facing pressures from a high US dollar. And on the war front, in-person talks between Ukraine and Russia negotiations will resume this week. Official says, meanwhile, President Joe Biden sought to clarify his call for the removal of Vladimir Putin, saying he wasn't seeking regime change after European allies raised concern. Tensions with war. Okay. Nothing substantial. A quick sentiment check. So yields are rising. Stocks advance. Nasdaq's dipped as investors also monitor Russian war in Ukraine. The war continues to stop supplies. What is happening with China? It adds to more concerns of does add to the supply chain disruption. Electrical Tesla implants suspend production at its Shanghai plant for at least 1 day. People familiar. Ukraine and latest geopolitical talks. The person talks this week. President Joe Biden tried to temper comments calling for the removal of Vladimir Putin. Global shares have recovered, and maybe that what we're seeing is more a bear market rally. Chris Weston says, big question and moves. Okay, nothing much more from that. Let's bring out a Forex calendar and we can wrap up this video. So again, as I mentioned, a lot of economies, a lot of counters moved forward here in Europe now as well. In the UK, we moved 1 hour ahead. So if you see any times in GMT, bear in mind that you need to add 1 hour. On Monday, we don't have any data to work with. On Tuesday, we don't have any important data to work with either. Going to Wednesday, we have a little bit of data coming through on the US side, but nothing interesting. Then everything happens on Thursday and Friday. On Thursday, you're going to see core PCE come through for the US, very important. We also have some manufacturing come through from China, expected to come a little bit lower, which might hit sentiment. So we're keeping an eye on that. And on Friday, we have the final manufacturing data. And most important, we're going to have the CPI flash estimates for Euro. So here it's showing you in yellow, there should be high impact red, and we also have NFP data. But mind you, all of this core PCE is where we're probably going to start pricing in some more of the Euro moves. On Thursday, we're going to have OPEC as well. But all of this is telling us there's more inflation stay in the pipeline, and that cannot be positive. That cannot be positive for Euro or the pound right now. So that's the direction we'll be trading. right around Thursday after the US PCE, I'm expecting to sell the pound more aggressively and also the EURUSD as we head into NFP, where I'm expected to be quite strong for the US economy. Apart from that, we have to wait and see where the trades develop. USD CAD is still strongly correlated with the S&P 500. So if you see S&P 500 making any substantial moves, you can expect USD CAD to make those moves with it. Apart from that, I'll be very nimble to see where we're going to find our trades from, and don't push it at this point. As we are heading into April, there's going to be a lot of volatility in the first week of April, which is next week, and we got much more trades to go and work with. Thanks everybody for joining in. This session was really long because I really wanted to cover everything I can cover, and then we have a good platform to work with for the rest of the week. Thanks everyone for joining, and that is all from me for now.